Now, back by popular demand, it's the Lance Roberts Show.
And good morning. Welcome to the show at 6:06 as we get ready to go for the day. We've got a couple of big things happening today and tomorrow in particular. The Federal Reserve is into their two-day meeting starting today. And, of course, tomorrow is going to be the big press release about, what they're going to decide to do in terms of are they going to continue to hike interest rates? And more importantly, what about that big balance sheet, $4 trillion? A rumor from the Wall Street Journal on Friday suggested that, they may actually consider slowing down the pace or maybe even stopping quantitative tightening, right? This is where they're reducing that balance sheet. And of course, this follows the 20% decline in the markets from October of last year. And, it's interesting that despite the fact that Jerome Powell, and we had a long conversation yesterday with Carolyn Baum, we've got some notes from her today, a couple of clips, we'll be releasing a full podcast of our interview with Carolyn Baum here. What day are we doing that?
Could do that on Wednesday at noon.
Wednesday at noon. So there you go. So go by the website Wednesday at noon for our latest podcast with Carolyn Baum. But we talked specifically about the Fed and what they're expected to announce on Wednesday, which will come out about 2 o'clock. So we'll release that interview before the Fed announces, and we'll see if Carolyn was right. But the point here is that it didn't take much for the markets. The markets are down 4.4% last year, biggest decline in the decade, right? So there you go. There's one thing you should be kind of scratching your head about. 4.4% decline in the markets last year. That's the biggest decline in a decade. Now, why? Which is abnormal, by the way. But more importantly, why is it that we're so worried about that? Because over the last decade, it's been primarily a function of central bank liquidity, right? So we've had this tremendous amount of liquidity injected into the financial markets to lift those asset prices. And then we all run around and we wonder why we have this big wealth disparity in the country between the uber rich and the bottom 90% of the economy that have basically no money in the bank. You ask most individuals, how much money do you have in your 401k plan? The average balance is about $28,000. So if you've got more than $28,000 in your 401k plan, good job. You're actually doing better than the average. Unfortunately, most people have far less than $250,000 in their 401k plan. So if you've got more than $250,000 in your 401k plan, congratulations, you're now in the top 2% of the economy. So look, think about that for a moment, is that most people are moving into retirement with absolutely no money saved for retirement planning, right? Because, and think about it, we're busy, right? We're raising kids, we're paying for college, we're paying for health insurance that we can't afford, and so life tends to get in the way of saving for retirement and doing the things we need to do financially to be prepared for retirement. And this comes at a time when we have an aging demographic, where there's huge aging population. Brent getting older every day. He's right there.
Hey, I resemble that remark.
Me too. But, we've got this huge aging demographic, which is becoming more and more of a burden on Social Security. Now, why do I bring that up? This all comes to the fact that yesterday, the CBO, which is the Congressional Budget Office, released their latest budget predictions going forward over the next, 10 years. And that shows a increase in the national debt, right? What we call debt to GDP. So how much federal debt are we issuing relative to the economic growth? That's expected to grow to about 130 to 140% of debt to GDP. Now, to put this in perspective, once you cross 100% of debt to GDP, right now we're about 106% of debt to GDP. And already our economic growth rate has slowed from 6% back in 1980 to 4% in 2000 to 2% today. So this is kind of, and that varies. It bounces around a bit. You may be 2% 1 year, 2.5% the 1 year, but since 2000, the average growth rate of the U.S. economy is 2%. So it's not surprising that when you have surging debt that you have to service and pay, and again, almost 80 cents of every dollar that we collect in taxes goes to pay the debt, it's not surprising that you get slower economic growth because you're diverting productive resources into non-productive investments, right? Paying interest on the debt is not a productive use of tax dollars. Paying out Social Security, Medicaid, welfare, prescription drug benefits, the support for the Affordable Care Act, those are not productive investments, right? So that's money that gets invested and spent, but doesn't create longer-term revenue streams. So this is a problem with debt to GDP. And while there's many that say, oh, don't worry about the debt because, well, we can always print money to pay it. It's true that that is the case. We can print money to pay our debt, but that doesn't mean that that's becoming productive economically to grow the economy stronger. So it's very interesting when you take a look at the report about the dynamic here, because again, over the last decade, and this is continuing on, I mean, we're just moving from one budget resolution to the next without any type of real budgetary process. We continue to spend more. We're spending the actual perceived spending for this year is going to be $4.5 trillion. So, we're going to spend $4.5 trillion in the course of the next budget year, and we're going to have to basically issue out almost $1 trillion in debt. We're running a $1 trillion deficit at a time that we've got, supposedly booming economic growth. So the point here is ultimately that this is something that we need to wind up paying attention to. And despite the fact that Larry Kudlow, who's the National Economic Advisor, says, hey, don't worry about the CBO report, I disregard it. I don't believe it. That's fine, but the data is pretty much the data. And whether you agree with the CBO or not is not really that important, because the long-term historical data of the economy in terms of our debt and our spending and the impact on economic growth, that record is extremely clear. Over the last 30 years, economic growth has only gone in one direction, and that's been slower, not stronger. And that's is coincident with the rise in our debt. So keep a watch on this. Something we'll talk about some more. But real quick, the market did rally up yesterday a bit after its initial sell-off, but we still sold off yesterday. Importantly, kind of keep a watch on what's happening with the markets here. We're trending right along the 50-day moving average currently, but more importantly, the market is starting to act like it is trying to top here. So again, a breakdown back below that 50-day moving average is likely going to be retest of lows. A lot of this hinges on what the Fed says on Wednesday. We're going to talk some more about that. Then coming up at 6:30, Richard Rosso, Certified Financial Planner, will be here as well in studio to talk about our upcoming event. Don't go away. More of the Lance Roberts Show coming up next.
Check out the show. Yeah, they were dancing and singing and moving to the grooving. And just when it hit me, somebody turned around and shouted, play that funky music, white boy. Play that funky music, right.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.